So, how are these bond prices decided? The government sells bonds in Treasury auctions at a set schedule, weekly or monthly depending on the maturity of the bond, and the yield at auction will depend on how much demand there is at that auction for these bonds. This is called the primary market. When new Treasury bonds are sold in the primary market, the yield at which they're sold becomes a benchmark. Investors in the secondary market will then look to this price to reassess the value of similar bonds that are already in circulation. Investors are constantly buying and selling bonds on the secondary market based on what they think is going to happen to rates. They're constantly guessing if the rates are going to go up or down, if the economy is going to speed up or slow down, if inflation is going to go up or down. These questions will determine what yield makes sense for them to loan their money out at. This means that market interest rates are really just the yields that global bond investors are demanding at that current time. It's all based on what they think is going to happen in the future. Now, if market rates go up, that means that the cost for the government to borrow also goes up. And it also means that the interest the government has to pay on its debt goes up. Remember when I told you that the US government debt was currently around $36.7 trillion? Well, not only do they have to pay that back, but they have to pay it back with interest. And the interest payments alone are currently around $3 billion per day. This makes market rates very important because it determines if their interest payments are going up or down.